January 2, 2000. The Real Estate Capital Scoreboard January 2000. As a result of sluggish loan demand, mortgage spreads dropped by about 10 basis points since the Thanksgiving holidays. Mortgage rates now range upward to 8% for 5-year loans and about 10 basis points more for 10-year funds. The overall Treasury spreads fall within 170 to 260 basis points. Real estate equity markets remain relatively unchanged. Overall market highlights are as follows. According to Freddie Mac, the 30-year residential fixed-rate mortgage climbed above 1% for the second time in the past 12 months, the highest figure since August. Consumer confidence levels are at their highest 1968, notes the Conference Board. Strong economic news rekindled inflation fears and Treasury bond prices dropped to their lowest levels since early August. On a final note, the U.S. economic growth is expected to slow down to about 3% this year, accompanied by a slight rise in unemployment.
February 1, 2001. The Real Estate Capital Scoreboard February 2001. Despite wide movements in treasuries last month, rates are slightly higher, nearly 20 basis points, since the end of 2000. With a slowing economy lurking, loan proceeds often supersede rates as main underwriting concerns. Available since 1959, the one-year Treasury bill was eliminated by the Treasury Department based on declining interest in this maturity. The Fed's job of 50 basis points was less than many expected. Swap spread pricing over treasuries is rapidly gaining popularity as the benchmark for CMBS lending. This formula eliminates many risks associated with treasury spread movements in pricing mortgages.
April 1, 2000. The Real Estate Capital Scoreboard April 2000. Although spreads over treasuries widened by about 50 basis points during the past month, overall rates are only about 25 basis points higher than a month ago because of lower treasury yields. The treasury continues behaving in an inverted fashion as the 5-year maturity is about 30 basis points higher than the 10-year term. Most borrowers obviously still favor the 10-year index, despite an overall spreads premium. As for overall financial markets, bond market defies the Fed's quarter-point hike and the bank prime rate increases to 9% as the 10-year Treasury rates inched downward.
May 1, 2000. The Real Estate Capital Scoreboard May 2000. Rates are about 0.25% higher than a month ago. LIBOR jumped over 10 basis points, while one-year treasuries are more in line with 10-year note. 5-year rates remain disparate or should only high, about 0.25 point more than the 10-year term. Thus, 10-year maturities are the favored benchmark for most lenders and borrowers. Mortgage spreads over treasuries are stabilizing after a highly volatile month. Most spreads are within the store call range of 225 to 275 basis points over comparable term treasuries. The expectations are that the Fed will keep raising rates to curb inflation and forced short-term rates to remain high. As a result, mortgage market volatility forces many lenders to seek alternative rising benchmarks. Area swap rate spreads are becoming more prevalent as a protection tool.
July 1, 2000. The Real Estate Capital Scoreboard-July, 2000. The current rate range starts at 8%, translating to 200 basis points over comparable term treasuries. The yield curve remains inverted as 10-year pricing is 0.25% more favorable than the 5-year term. Higher rates keep sending borrowers to floating-rate debt programs. Index selection is popular, whereby switching between LIBOR and treasuries is done where applicable. The Fed keeps rates unchanged, resulting in a slight drop in mortgage rates. The economy shows signs of cooling as housing starts are down and retail sales declined. In addition, construction spending slows after 6 consecutive monthly increases. September 1, 2009. The Real Estate Capital Scoreboard-September 2009. Chicago, Illinois, September 1, 2009. Declining property values, prices reset, investment yield boundaries for all types of income-producing properties. No asset classes are immune, ranging the entire spectrum from institutional quality, credit net lease deals to distress hotel ventures. With limited exceptions, new construction developments grind to a halt as investors rethink risk/reward because of ever-eroding market fundamentals. The DeFi takes front stage among lenders with legacy loans, whereby debt terms are defensively renegotiated. All parties try to avoid foreclosures as long as the collateral is reasonably maintained at occupancy levels within the given submarket. DeFi loan sizing is further outlined as follows. Other than senior housing in select markets, few properties see any rental growth. Protecting existing cash flow remains a top priority in contrast to any increases. Pro forma projections are reviewed downward, as owners expect stable or declining rents/occupancies. For instance, multifamily properties with rental decreases of 3% or more are underwritten and trended downward versus trailing operating history figures. Markets are strained with a special emphasis providing some form of debt relief in key markets, for example, Florida, the Inland Empire, Phoenix, Austin, Las Vegas, Atlanta, the Upper Midwest. Voluntary conversion of debt to partial equity is offered as an additional solution to eroding debt balances, increasing 2% or more on vacancy rates for apartments. Roll-in of the prepayment penalty deemed to be a cash-out, defined as an optional cost to better their financing, hard-lined by FNMA-small penalty, for example, 2%, not a big issue if a couple of 2% on LTV but not 75% to 80% jump, for instance. Standard provisions include lengthening amortization schedules and loan term, offering interest-only payments, reducing, or removing, non-monetary default provisions such as debt service coverage and loan-to-value covenants and partial forgiveness of debt. The Real Estate Capital Institute's advisory board member, Harold Skip Harry, laments, "The volume of foreclosures and restructuring leads me to believe the end is not in sight for at least 1 to perhaps 2 years." Skip suggests, defensive investment tactics are the norm rather than the exception until more trades occur and properties are marked to market based on current conditions.
October 1, 2000. The Real Estate Capital Scoreboard-October, 2000. No substantial change in mortgage or equity rates. Although Treasury rates increased more than 10 basis points this month, most lenders dropped required rents by nearly the same amount. The Fed is expected to leave borrowing costs unchanged for the third consecutive time as signs of a slowing economy emerge. Also, recent data on consumer spending and factory output indicate a slowing of the record expansion over the past few years. More lenders are quoting securitized pricing, which is based on a calculation of actual number of days of interest paid each month. In contrast, most insurance companies still provide rising on a 30-day/360-day calendar calculation, using an equal number of days each month. The securitized pricing premium represents nearly 0.1% increase for a 10-year loan.
November 30, 2000. The Real Estate Capital Scoreboard November 2000. Overall rates dropped slightly by about 10 basis points this month. Otherwise, most mortgage indices are steady. Consumer confidence is at its lowest level of the year, but still very favorable, considering the 10-year economic boom. Productivity gains also keep inflation in check, despite a 30-year record low unemployment rate. For the first time since 1998, mortgage-backed securities enjoy a more favorable pricing than corporate bonds. Investors see mortgage securities as offering greater diversified risk backed by properties located in different regions. December 1, 2000. The Real Estate Capital Scoreboard December 2000. Mortgage rates are at their lowest levels of the year. Overall rates dropped by about 10 basis points with the spreads starting at just under 200 basis points. Best rates are at 7.5% for both 5 and 10-year terms alike. Mortgage spreads are actually competitive as commercial debt attracts better pricing than various investment-grade corporate bonds. The trend for secured financing continues in contrast to unsecured corporate borrowing. Treasury rates continue downward movement, dropping about 20 basis points since October and nearly 30 basis points since September. The presidential election gridlock resulted in interest rates dropping by about 5 basis points, otherwise the Fed kept rates unchanged.